Hey, Arthur Hill here with TrendInvestorPro.com. I'd like to welcome you to Next Level Charting. Remember, you can watch Next Level Charting every Thursday at noon Eastern Time, and you can also watch it on our YouTube channel. And if you like this video, please give us a thumbs up. So today I want to review some of the technical damage and the bounce. In particular, we're seeing the percentage above the 200-day EMA really down and showing some serious technical damage within the indexes. And we'll look at XLK and XLV as they led the bounce. And I'll show you that correlations do rise in bear markets. So last week I showed how advanced decline percent, which is the percentage of net advancing stocks in the S&P 500, was improving even as the market was moving down in this stage here towards the middle of March, and we got the bounce. And I saw a tweet from Rob Hanna of Quantifiable Edges, and he noted that up volume on the NYSE was very weak on Monday. And of course, Monday we had a 3% gain in the S&P 500. And so I've got AD volume percent for the S&P 500 in the first window, the S&P Mid-Cap 400 in the second window, and the S&P Small Cap 600 in the third window. And this indicator is measuring the percentage of net advancing volume. So you have up volume minus down volume. That's the volume that goes into advancing stocks, less the volume that goes into declining stocks, and you divide that by the total volume. And because you divide it by total volume, you normalize it, and then you can compare it for each index or also with the sectors, because StockCharts calculates AD volume percent for the 11 sectors. So if we look at this indicator here, here's the S&P 500 advancing 3% on Monday, big move, but AD volume percent hit 34%. That's a very weak reading for a 3% advance. And if you look at mid-cap AD volume percent, it was even weaker, and small cap AD volume percent was actually negative. That is the bar just before that black bar. And we don't have today's, I'm doing this recording on Wednesday, April 1st, and the advanced decline volume percent indicators come out after the close because they need to be calculated and published. But what this was showing was really weak buying pressure on that advance on Monday. Now, I'm not going to call a top here because, frankly, I think trading in bear markets is a very dangerous game because you almost have to be, well, pretty much you have to be making decisions near the close, because you can see today we had like a 3% gap down on the open. And so you would have had to have made a decision maybe before that gap, unless you're going to have a wide stop loss. So I think this is more informational, if anything. But we are in a bear market. We've had a bear market rally. And if you look at this decline here, you have a decline and you have a bounce, and that retracement's about 38%. And that's about the garden variety retracement in a bear market. Maybe we get up to the 50%, but this is, a danger zone of continuing lower, or at best having some sort of a choppy range. So StockCharts also calculates AD volume percent for the 11 sectors, and it has just gone crazy over the last few weeks since the latter part of February. So I've got it for the 6 big sectors here. And the reason I chose these sectors and I concentrate on them is because they account for like 78% of the S&P 500. So I just jumped over to the ssga.com website. That is the fund family for SPY to look at the holdings. And there you can see the top stocks. Microsoft is the top holding now in the S&P 500 and in SPY. It's ahead of Google. And if you look down here at the sector allocations, there you can see them laid out. Information technology above 25%, healthcare 15, financials 11, communication services almost 11, consumer discretionary at 10%, industrials down to 8.2%. And as far as I'm concerned, these are the most important sectors, these 6 sectors, because they are offensive sectors in nature. Healthcare may be a little less so, but they are the big drivers in the S&P 500. And the other sectors, yeah, sure, they can be important, but not as much so. Look at energy. It is now below utilities and real estate, and it is the second smallest sector. And if it keeps this up, it's going to be the smallest. So returning to the AD volume percent charts. Now, keep in mind that this big update here, the second bar from the right, is Monday when we had the big advance. So this is AD volume percent for XLK, and it participated Monday. But look at XLY. AD volume percent was negative, and that means there was more volume flowing into declining stocks than advancing stocks for XLY. Consumer discretionary, that is the most economically sensitive sector. So we're seeing leadership from technology, but not from consumer discretionary. And then if you look at technology, I mean, come on, it's all over the board here. Look at these readings below minus 80% throughout February, March, and then you can see these readings above 80%. There are several, but there are more readings below minus 80%. So selling pressure is still the dominant force at work here. Then if we look at finance, we can see not a big day for AD volume percent on that advance on Monday. And I'm going to scroll a little bit further down to show you the other sectors that I have here. We have industrials, and you can see that it barely registered on Monday's advance. AD volume percent was barely positive. Communication services had a big day, so it did register, and healthcare had a big day. So we've got basically communication services and technology doing all right, but we have consumer discretionary, finance, and industrials dragging their feet. And that's just one day now. Keep in mind, all 6 of these are in downtrends of some sort. So to get an idea of the overall health of the market, you can look at the percentage of stocks above the 200-day EMA. So first we got the S&P 500 here in the top window, and there you can see the breakdown, and there's the 20-day moving average moving below the 200-day in mid-March. And then if we look at the indicators here, we can see weakness throughout these indexes. The S&P 500, the percentage above the 200-day moved below 20%, and it has not been back above on this bounce. For the S&P Midcap 400, it didn't even get back above 10% on this bounce. Small caps did not get above 10%. And if we look at the NASDAQ 100, it did make it above 20%. So it has it's say the cleanest shirt of all the dirty shirts. All these shirts are dirty. All these indexes are bearish overall, but the NASDAQ 100 is perhaps the least bearish. And we can do the same with the technology sector and the other 5 big sectors. Look at the percentage of stocks in each sector above the 200-day EMA. And these charts that you're looking at are part of the Essential Breadth Indicator chart list, and that is available to subscribers at trendinvestorpro.com. You can just take a 1-month subscription, $29, and you can get this chart list, and I'm sure you're going to get your money's worth just out of the articles that are already there. So if you want to come and take a trial, a 1-month trial, you can come and go as you please, cancel at any time, but this chart is part of that chart list as well as these others. So if we look at this here, we can see that XLK, we got up to 20%, but fell back. So still the vast majority, 80% or more of stocks in XLK are below their 200-day EMA. That means they're in downtrends. And you see I've got these lines here at 60 and 40. And that's because that is my line in the sand, basically, or lines in the sand. When you get above 60%, you've got critical mass, enough stocks in uptrends to support an uptrend in that sector. And you can see that that stayed like that until February when we got below 40%. And I don't use the 50% level because you're going to get too many whipsaws. But I look for a serious move in one way, one direction or the other. So when you get below 40%, that means 60% or more of stocks are below their 200-day EMA, and that's bearish. And technology was the last one to do that in the second week of March. You can see consumer discretionary triggered in late February, and you can see fewer than 10% of stocks in the consumer discretionary are above the 200-day EMA. Same with finance, fewer than 10. And this one also triggered with that move down below 40% in February. So a lot of weakness in the market as far as the longer term trends are concerned. This crash, unsurprisingly, did some serious technical damage. Look at industrials, fewer than 10% of stocks above the 200-day. Communication services. Now, this is a small sector. The other 5 sectors have like 60 stocks in the sector, whereas communication services has 22. So that means it takes fewer stocks to influence this indicator, and it's more prone to whipsaws, if you will. But it triggered there in late February. Now, move back above 40% doesn't negate the signal like we had here. You need to get above 60%. That's why I put these thresholds above and below that 50% level to reduce whipsaws. Yeah, I might be a little late to some signals, but I would rather reduce the whipsaws. So you can see here that it got almost to 20%. And then you look at healthcare, it got almost to 20% as well. But still, the message here is of these 6 big sectors, which account for like 80% of the S&P 500, more than 85% of the stocks in these sectors are below the 200-day EMA. That's a lot of stocks in downtrends. So you can see the technical damage in the sectors and how almost every stock is participating. 85% of stocks are below the 200-day EMA. And I ran a little scan here just to show you how hard it is to pick stocks in a bear market environment. This is a scan doing the S&P 1500, which is the S&P 500, the S&P Mid-Cap 400, and the S&P Small Cap 600. And I'm looking for stocks that are positive over the last 29 days. And if you're picking stocks, you would need these to be positive over the last 29 days to make money in a bear market. So if I click run on that scan, you can see the results, 37. So that is 2.47% of stocks in the S&P 1500 are above or up since February 19th, which is when SPY peaked. And that makes it really, really hard to pick a winner. So that concludes this edition of Next Level Charting. Again, I'm Arthur Hill with TrendInvestorPro.com. If you're watching this on YouTube and you like this video, please give us a thumbs up. Thanks very much for tuning in and have a great day.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.